ask you a question, and that is, why does your credit score matter even after you're retired? Picture this, two retirees, both with similar backgrounds, both with similar savings, but one's living comfortably while the other's struggling to make ends meet. What's the difference? It's the credit scores. So today I'll share a story that'll open your eyes to the hidden power of credit even in retirement. You might be surprised how much it can impact your golden years. So stay tuned to find out. Let's start by taking a look back at yesterday's show. Yesterday we talked about how to keep from burdening your heirs with an inherited IRA. And if you missed it, I want to encourage you to catch up. It was packed with crucial information that could save your loved ones a lot of headaches down the road. As always, you can find all of our episodes at AskRalph.com. Today's question comes from Abby, and she's actually in Ohio. This is what she wrote. She said, "Dear Ralph, I'm approaching retirement in a few years, and I've always thought that once I stopped working, my credit score won't matter much anymore. I've heard from friends actually talking about not even worrying about paying their bills. They claim that their credit is of no consequence. I also think that, after all, I won't be taking on new loans, right? But lately, I've been hearing conflicting advice. Can you shed some light on this? Should I be concerned about my credit score in retirement?" Well, Abby, let me start by thanking you for your excellent question, and it truly is an outside of the park great question. And it's a common misconception that a lot of people have. They think that these credit scores become irrelevant once they retire, but nothing is further from the truth. And your credit score will significantly impact your financial well-being well into retirement. And I've got some great real-life stories that illustrate this perfectly. Now, I want to remind you, this show is all about answering your question, just like Abby's question today. That's why it's called Ask Ralph. So keep those questions coming. You can send them to me. Here's my email address. It's ralph@askralph.com. You can also visit our website. That's at askralph.com. Click on that microphone icon and just tell me what's on your mind. I want to thank you for joining me today on this journey. It's our Financial Friday. Now, before we dive into today's topic, I want to remind you to visit our website. That's at askralph.com. I want you to join our community. I want you to share this show with others who might benefit from this information. And when you join our community, you'll get a free copy of my book. It's called Mastering Your Finances. Now, you can buy this book on Amazon. It will cost you $10, but it's yours absolutely free when you join our email list. So go do that right now. Well, let me start by sharing a relevant Bible verse. This comes to us from the wise book of Proverbs, chapter 22, verse 1. And it says this: "A good name is more desirable than great riches. To be esteemed is better than silver or gold." That's a powerful verse. And it reminds us of the importance of maintaining a good reputation, which in our modern world is simply a good credit score. Now, there's a lot of other things, but part of that good reputation is a good credit score. Well, let me tell you a story about two of my clients, Tom and Jerry. And no, I'm not talking about the cartoon characters, but their financial situations were just as dramatically different. Now, Tom and Jerry, they're both 65 years old, and they had both just retired. They had similar backgrounds. Both had worked in middle management positions for most of their careers. They had comparable retirement savings. Each of them owned homes. They're about, the same in value. And on the surface, you'd think their retirements would look pretty much the same. I mean, they worked the same jobs, so they had about the same amount of retirement savings. They both owned homes of similar value, so you'd think they were about the same. But there was one crucial difference, and that was their credit scores. Now, Tom had always been diligent about maintaining an excellent credit score. Tom paid his bills on time. Tom kept his life in order. He kept his credit utilization low, and he was careful about opening new accounts. As a result, Tom had a great credit score, over 800 points. Now, Jerry, on the other hand, well, let's just say he's been a little less careful. Jerry sometimes missed payments. Jerry maxed out his credit cards and had a few negative items on his credit report. And here's the problem with Jerry. His credit score was a problematic 580. Not great. Now, you might be thinking, Ralph, they're retired. Who cares? They've got their savings. They got their Social Security. How much could their credit scores really matter? Well, let me tell you, it mattered a ton. It mattered a lot more than either of them expected. About a year into retirement, both Tom and Jerry decided they wanted to downsize their home. They had these big homes that were too big for their kids had left the nest, and The housing market had changed, and they both wanted to find a smaller downsized house, and they both found one. They both found properties which were more manageable and were better suited for their needs. Now, Tom, he had the excellent credit score, and Tom was able to secure a new mortgage at, guess what? A fantastic interest rate of 3.5%. Well, what did this mean for Tom? His payments were manageable. It gave him the ability to live comfortably and to afford his new home, and he still had money left over for travel. He did all kinds of traveling. He took vacations, and he was able to spend that money that he had left over on those fun activities in retirement. Now, Jerry, as you might have thought, faced a very different situation. Now, Jerry had poor credit, like we talked about, a 580. So when he went to buy this house, he was what they call a high-risk borrower, and nobody wants to deal with a high-risk borrower, especially right now. He could get a loan, but the best interest rate he could get was 7.5%. Think about that for a second. That's double Tom's rate because of his credit score. But what did that high rate mean to Tom? It meant it significantly increased his monthly payments. Think about that for a second. Jerry had that rate at 3.5%. Tom had it at 7.5%. So think about how much of an impact that was. That increased his monthly payments. And guess what that did? That put a strain on his retirement budget. But guess what? The impact didn't just stop there. A few months later, both Tom and Jerry needed to replace their cars. They had downsized, and all of a sudden their car didn't work for them anymore. Now, Tom, he had the high credit score. Goes into the car dealership, finds the perfect car he wants, sits down with the finance manager, and the finance manager says, Tom, I can see that you honor your credit. So guess what? Right now, we're offering 0%. Yes, I said that. 0% APR as a promotion on that new car. So guess what? Tom was able to finance his purchase without paying any interest at all. 0 interest. That is fantastic. Now, Jerry went into the car dealership, and he wasn't so lucky. The best auto loan that Jerry could come up was 11%. He sat in the finance guy's office. He found the car he really wanted. The finance guy says to him, he goes, Jerry, listen, you got some bumps on your credit, my friend. And it's going to be hard to get this, but you know what? I found a lender who will do this. But unfortunately, the interest rate's going to be a little high. It's going to be 11%. Well, Jerry said, wow, man, I can't afford this car at 11%. So what did Jerry have to do? He had to settle for a much cheaper car. Because if not, he was going to stretch his budget too thin trying to make those big payments because of that big difference. Think about that. 0% APR, 11% is going to impact you and what you're able to afford. But guess what? The differences continue to pile up. Let's talk about Tom. Tom wanted to take a dream vacation. He didn't want to pay for it all up front, so he was able to open up a new rewards credit card with a generous sign-up bonus. They gave him several $100s just for signing up. Now, Jerry, on the other hand, he was able to qualify for those premium credit cards, and he missed out on those perks. Another thing, a lot of people don't think about this one. Even their insurance premiums were affected because guess what? Most insurance companies use credit scores now. They use it as a factor in determining rates because they look at it as your character. Now, in our situation, Tom had a high credit score. He got low premiums on both his home and his auto insurance. Unfortunately, Jerry, who didn't honor his credit, had to pay significantly more for the exact same coverage as Tom. So as the years went by, these differences compounded. With Tom, good credit, his lower expenses meant he could leave more of his retirement savings invested. He was able to let that money grow. Jerry, on the other hand, because of his credit score not being great, he had to withdraw more from his savings each year because he had higher expenses. But what did that do? It depleted his nest egg faster than he anticipated. So let's take a snapshot. 5 years into retirement, the financial pictures of these two men who started in similar positions, like we talked about at the beginning. They were in the same place. They were at the same starting line. But now 5 years into things, they are completely on different planets. Tom's living comfortably. Tom has got his feet up. He's enjoying retirement. He's got peace of mind. He honored his credit, and he's reaping the rewards from that. Jerry's not so lucky. Jerry's living a stressed life about money. He's constantly worrying about whether his savings are going to last because he's having to use that to pay his expenses. Now you might be asking, Ralph, dude, help us here. Is there anything Jerry could have done differently? Yes, absolutely. There's things he could have been done differently. And here's the silver lining to the story. And if you listen to me, you know I say this all the time. It's never too late to start improving your credit score. So let's talk about some actionable steps that you can take whether you've already retired or planning for retirement. Listen, I've talked about these on many shows. So I'm going to encourage you to check them out. But I'm going to give you a quick recap of those things right now. So one of the things that Jerry could do is he could check his credit report regularly. You're entitled to this free credit report every year. This is something you've got to do. Review those reports and carefully dispute any errors. Now, in Jerry's case, I think Jerry just doesn't care. Jerry just says, the heck with it. I'm retired. I don't really give a crap. That's a good way of saying it. Another thing you can do, and again, this is something Jerry's not doing, is pay your bills on time. Maybe you set up automatic payments if you need to. Because the truth is, payment history is the most significant factor in determining your credit score. Like we said with Tom decided to keep his credit utilization low. Tom never lets his credit become more than 30% of his available credit. And that's the key. That will help you on your score. Jerry, he could care less. The next thing, this is counterintuitive. A lot of people don't get this one. But don't close old credit accounts even if you're not using them. Because one of the components of a credit score is the length of your credit history. Another thing you got to do, and this thing I think Jerry learned the hard way, you got to be cautious about opening new credit accounts. When you open a new account, it's going to decrease your credit score. And if you need to go get money because you've got a situation like Jerry had, Jerry wanted to buy that new home and Jerry wanted to buy that car, because he was already circling around looking for credit, his score was diminished. And the last thing, I can't stress this one enough. If you're struggling with debt, consider credit counseling or debt management. Again, I did a show on this a few weeks ago. I'm going to encourage you to do that because they can help you get back on track without damaging your credit score. And I can help you as well. And I'll talk about that a little bit later in the show. Remember this, improving your credit score is a marathon. It's not a sprint. Listen to me on this. It's a marathon. It's not a sprint. It takes time. It's not going to happen overnight. But the benefits, as we can see just in this simple example of Tom and Jerry, can make a huge difference in your retirement. It could really make the difference of whether you're enjoying your retirement or you're living this stressful existence. And nobody wants to live a stressful existence. Well, let's wrap up a couple of key things we talked about today. Number one thing, if you haven't heard anything else I've said today, your credit score matters significantly even as you transition into retirement. And I could argue maybe even more because you don't have a lot more time to recover from things. You don't have that extra money coming in to solve things. Second thing, a good credit score can lead to lower interest rates. It can lead to better insurance premiums and more financial opportunities. We learned that today. Number three, poor credit can strain your retirement budget and deplete your savings faster. It's simple math. If you're having to pay more for the same things as somebody else, you've got to be getting that money from your retirement. So guess what that's going to do? It's going to deplete your savings, which means you're going to have less to keep investing and less to grow. And the number four, and this one I got to stress, it's never too late to start improving your credit score. You can start today. You can start with a little thing. That's the thing. A lot of people get hung up on, but Ralph, I got this huge mountain to overcome. Well, guess how mountains are overcome? By taking the first step. So I hope this story of Tom and Jerry has illustrated just how important your credit score can be even after you stop working. Remember this, your financial health is an ongoing journey. Your credit score is a crucial part of that journey at every stage of your life. Well, thank you for tuning in to today's episode. Tomorrow, I'm going to be playing my interview with Paul Granger. Now, Paul and I had a great interview. It was on his show, and we discussed how living a financially secure Christian life is possible. It's a powerful conversation, and I want to encourage you to check it out. Well, let me just say right now, maybe after today's episode, you're like, Ralph, dude, man, you brought it down today, man. I'm feeling terrible about my situation. I'm retired. My credit stinks. Well, maybe you're feeling overwhelmed. All this information has caused you to worry. Well, I'm going to say this. I want to encourage you. I'm going to help you. If you schedule an appointment with me, we can create a personalized plan for managing your finances. And you can do this by going to AskRalphPodcast.com/store. Do it right now. I will charge you a $150 consultation fee. and I will work with you to improve your personal finances. Maybe it's your business finances you're worried about. Maybe you're looking for ways to grow your business. I can help you with all of these things. The overall goal is to help you achieve all your financial goals. So schedule today and let's create a plan that ensures your financial success. Remember this. My passion is to help you achieve financial success. I truly want you to live out your dreams. I want you to grow in your faith. And I know together, if we work together, we can master your finances from a Christian perspective. So as I always say, I always end the episodes like this. Stay financially savvy and may God bless you abundantly.
Thank you for joining us on the Ask Ralph podcast. And with a simple click to subscribe, we'll invite you back to our next episode. And remember, financial issues don't have to be complicated. Just ask Ralph. The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media, Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.